looks
Yeah, I
good.
can see you.
Okay, awesome. Okay, chapter 10. So we are learning about budgetary planning. So this is a very useful chapter. Okay, so you know, in terms of budgeting, right? You think about in your life, right? You know, you have to think about how to manage your finance, right? You need to budget the amount of money, right? You have, and you also need to budget the amount of time, right? So you have so much time, and you are trying to balance the different commitments, right? You are working, you are studying, right? And you have some other things going on. So you know, budgeting, right? So we are using it in our daily life, right? Everyone is using it. Well, at least I hope so, right? I hope everyone is using budget in your life. So here we are learning the budgeting in the managerial accounting. So in the decision making context. So there are 5 learning objectives. Okay, 5 learning objectives. The first one is that try to understand the basics about the budget, right? So we want to know what would take to have effective budgeting, okay? And what are the basic components for the master budget? The second learning project is, you know, we are going to prepare the sales budget, production budget, and also direct materials budget. The third objective is we prepare budgets for direct labor, manufacturing overhead, and also selling administrative expenses. Okay, with all this, we are able to have a budgeted income statement. Okay, in 2100, when you prepare the income statement, those are the actual income statement, right? But here, when we talk budget, we are talking about a budgeted income statement, right? So you are trying to picture what your number will be like at the end of the year, okay? At the end of the budgeting period. Number 4, you are going to prepare a cash budget and also a budgeted balance sheet, right? And in the 2100, you know, there are 4 financial statements, right? You have income statement, balance sheet, right? A statement of cash flows, right? And the statement of change in the equity, right? So those are the 4 statements. And here you're going to prepare 3 budgets, okay? And then the last point is related to the non-manufacturing companies, okay? So that's our learning objectives for this chapter. We have 2 lectures today and Thursday to cover these topics. Okay, so what is the budget? Okay, what is a budget? Budget is a formal written statement of management's plan for a specific future time period expressed in financial terms. Okay, so it could be like 1 month, right, or a quarter or a year, right? So how much money you are thinking you can make? How much is going to cost you, right, to run the business, right? So you're going to have these dollars, right? Dollars numbers on the budget, right? So budget is the primary way to communicate agreed upon objectives to all parts of the company, right? So if you have a expenses budget, right? So everyone agree, right? You know, we only have, let's say, $1,000 we can use for softwares, right? So now we have already spent, you know, close $990, right? We have no money to spend. So the idea would be, well, maybe, you know, the company should not, there's no budget, right? There's no budget. There's no room, right, for further invest into the software, right? Maybe you have to wait until next year. So this is the primary way to communicate, right? These objectives, the company's objectives, to all parts of the company. Okay, so everyone kind of understand this is our goals, right? This is our goals. We are trying to hit this amount of sales dollars, right? So everyone in the company know our goal is $2 million of sales for this year, right? So there, you know, that's the communication, right, to the whole company. It's also a tool management may use to promote efficiency and discourage waste, okay? So we are expecting that the supply expenses is gonna be let's say $2,000, right? On my budget based on the experience, historical data, right? The amount of cost for supplies should be $2,000, right? That's the budget. And guess what? This year, that number, the actual number is already 2,500, right? So then right away, people will say, okay, so what happened, right? I'm gonna need an explanation. How come the supplies increased so much, right? Compared to the budget, right? And then you can say, oh, because of COVID, we have to supply this, all these cleaning things, right? All these cleaning supplies. That's why, right? This year, the supply expenses is higher. Well, that makes sense, right? But the whole idea is, if there's no good reason, if there's no good reason, that means maybe there are some waste, right? There is some inefficiency, right? So you can just spot these situations, and then you can hopefully to improve it, right? To improve it. Budget is also important basis for performance evaluation once adopted. Okay, so if you are the let's say if you have a car dealership, right? You have a parts, right? You have a parts department, right? So and then your target sales is $2 million, right? So I may sign the contract with the manager. If you meet this $2 million sales, I'm going to give you a raise, 10% raise, right? If you get way over beyond, let's say your sales is $3 million, you are going to get 50% of the raise in your salary, right? So you can see that how budget can be used for performance evaluation purpose, right? Do we have any questions on what is budget? So we are typing this concept from these 4 different aspects. Does anyone have any question? Okay. So basically, the management can plan ahead of time, right? They set up all these goals, right? All these goals so that this is something they are working towards, right? And they can use these goals, right, to evaluate their people, their managers, right? And therefore, the staffs, the personnel are motivated to work hard, right? They are motivated to work hard. And also, this budget is also coordinates the activities, okay? How much sales, how many units of goods we can sell this year, right? And then you have to make sure that you produce enough, right? Because you have a budget for sales. So that number will trigger, right, the question for the production, right? So sales department have a budget that's going to affect the production department, right? Because if I can sell more, you better produce more, right? Otherwise, we are running out of the items, right? Okay, and also if there's any issues, right, you can detect it right away, right? If you realize that certain items is way over the budget, right? So that flag like a warning, right, from the system. Something's wrong there, okay? So you can prepare it like I mentioned, right? How long the budget for what kind of period of time? It could be 1 month, right? It could be a quarter, could be a year, right? So sometimes if it's more than 1 year, there's a problem, right? Because when you are talking about the long-term planning, right? That's going to affect your estimate, right? Because if the time is future, right? If it's like 5 years, right, in the future, we don't know what is going to happen, right? So in our planning, in our estimate, our number is subject to error, is subject to uncertainty, right? So it makes the budget less useful, right? You think about, I'm going to have a 10 years budget, right? So, just because of uncertainty in the future, right? Your numbers are not accurate, maybe, so your budget is less useful. So usually you want to make sure your budget is short enough, right? So that it's useful, right? The number can be predicted with certain level of certainty, right? Okay, so has to be long enough to provide an attainable goal, minimize the seasonal and cyclical fluctuations, right? So it cannot, sometimes if you just have 1 month's budget, oh good, right? You meet your goal, but guess what? That's your busy season, right? So that's why here we are talking about, well, hopefully your budget is long enough, right? So to have, you know, a long enough period, right? To see out the whole business cycle, not just the busy season, right? But also the slow season, right? In that case, you know, your goal is realistic, is attainable, right? It's meaningful. Otherwise, I reach my goal in my busy season, right? What about in the slow season, right? And it has to be short enough for reliable estimates, okay? Short enough for reliable estimates. Okay, so basically some of the bigger companies, they would have a committee, right? Budget committee. They would include like president, treasurer, right, controller, those people, right? They include those peoples into that committee. Then they will together they will try to form a budget, right? And these people definitely has to have a good knowledge of how the company is running, right? They have to know the numbers, right? And then the committee acts as a review board where managers define the budget goals and the requests. Okay, so that's the budgeting process. So the bottom-up approach is called participative budgeting, right? Sometimes as a CEO, as a president, I can have all these ideas, right? What I'm hoping this company is going to be like, how much sales I want to reach, right? What kind of cost control, right, I want to achieve. But then the funny thing is, like, you know, you are not working at the front line, right? And sometimes this is all just fancy numbers, right? It's not realistic, right? So therefore, you want to have the participation from the bottom, right? From the bottom. Those frontline workers, they probably know very well in terms of the business transactions, right? How happy the customers are, right? You know, so basically you want to seek input from people who are in the lower level of the management, right? They probably have better ideas, better knowledge, better information. So then you would call this approach called participative budgeting, right? So this is the bottom up, okay? Bottom up. It's not top down. It's not like I'm the boss. This is what I'm going to say, right? This is my decision. Do it, right? This is called top down, right? So that decision comes from the top and is pressed down to the lower level of the management, right? But here we are talking about bottom up. So we are saying, well, guess what? You know, we respect the information, the amount of information those lower management team have. They probably can give us a better information so that we can have a useful budget, right? So that's what we talked about, the participative budgeting, okay? Okay, so what happened here is, okay, so there is a dangerous, right? Like I mentioned, in terms of the top-down approach is because your senior management team, they are distant from the day-to-day operation, right? So they can come up with numbers, but maybe those are just in their fancy thinking, right? Maybe those budgets are not reliable, right? Okay, and then guess what? The lower manager is like, you guys are crazy. You want me to achieve a sales like 3 million this year? You know, that's impossible, right? That's impossible. So, you know, you can give them a budget, but guess what? they think your budget is not fair, right? So they don't buy in your budget, right? So then how that can be useful, right? Your budget won't be useful, okay? So the bottom-up approach seems like it's good, right? There are advantages. So for example, the lower level managers, they have more information, more knowledge of their area, right? And also the lower level managers think it's fair, right? Because you know, you seek my opinions, my input into the project. That's fair, right? Because I have to do this job, right? And I know how it works, and I have more information. And now you seek my input. That's pretty fair, right? So there's a procedural fairness, right? Perception. So that helps, right? What's the disadvantage, right? So then what it means? That means this decision cannot be made only at the senior level. They have to have meetings with the lower level. They have to interview these managers from different levels, right? That means it's going to be time consuming. It's going to be costly, right? And also there's a very interesting called the budgetary slack, right? So if I'm the manager, okay, if I know that my performance evaluation is tied to that goal, what's my incentive, right? What should I do, right? I should try to make the goal as low as possible, right? So it's easier for me to achieve it, so I can get my bonus, right? So when you ask their input, guess what? These lower level managers, they will try to create a budgetary slack, right? If they are pretty confident, they can achieve 3 million, right? But guess what? He's gonna say, oh, I think we can do 2.7 million, right? So he's creating a slack that $300,000, right? There, just to make sure that even there something bad happened, he can still achieve his goal, right? So that's the disadvantage, right? Even though, you know, ideally these people have better information, they can help to set up a better useful budget. But guess what? Because their own incentives, right? Their self-interest, they may create this budgetary slack, okay? Budgeting is not a long-range planning, right? So budgeting is usually within 1 year, okay? Long-term range planning is more than probably 5 years, okay? Therefore, the goals set up in a budget is all short-term goals, okay? And it's quite detailed, right? Lots of information, quite detailed. For the long-range planning, well, you know, they could have a strategy, right? You know, they set out long-term goals, but they probably won't have as much detailed, you know, information in the budget, right? Because it's less, because this is a long-range planning, right? The long time period will create a lot of uncertainties in the information, okay? So it's not meaningful for them to put a lot of detailed kind of goals, objectives, right? But they should have a long-term strategy, right? Long-term strategy. Okay, do we have any questions so far? Yeah, Hussein?
Yeah, you said like the 1 year is the most common, like they usually do 1 year. And like, however, like there are some companies who do like 5 years for some reason, like, or less than 5 years, more than 1 year.
Yeah, so if you
for
have
some reason.
Yeah, if you have like a 5-year budget, those probably like a government, right? So like university government, so they kind of have a very good idea in terms of how much revenue, how much fundings they can receive, right, from the organization, right? And they have a very good idea in terms of, you know, what is our cost for University UFL, right? The major costs are the staff salaries, right? The professors, the supporting staffs, right? And so basically they kind of think, well, your government probably have a commitment, right? in the next 5 years, I'm going to give you, this much amount of the funding, right? So right away, they can budget that 5-year period with some confidence, right? With some confidence. And also the staff cost, that's under university's control, right? If they don't have money, they will not hire new professors, right? If it's more than the cost, they're going to lay off some of the employees, right? Not sure if you're aware, because of the government cut in the funding, right? I think UFL lost probably 40% of the fundings, if I'm correct, right? So then, it's a very, very tough situation. They have to let go maybe quite a few, not quite a few, maybe 100 people from UFL. Mostly probably supporting staff. People like me, they need me to work, so they need me to teach, right? They can't just kick us off, right? So for a lot of the supporting kind of admin type of work, they either combine them or they get rid of some of the positions. So the whole point I'm saying is, if you can budget for 5 years, and then with reasonable accuracy, right? Then you can do it, right? But in other business, let's say it's very volatile, right? It's in an industry or in a market that is very volatile. So they can still budget for 5 years, but how useful the year 3, year 4, year 5, that information would be, right? You have absolutely no
They
control.
can't estimate.
Yeah.
Yeah. Okay. Thank you so much.
So you can budget, but make sure that it's useful, because it's costly to do the budgeting, right? It involves people, and people spend a lot of time, right, to come up with a budget. You have to make sure it's useful. If you believe that this number is going to be different in 5 years, right? Or it's going to be quite different in 5 years, and then why would you spend your time, right, to do that? Yeah. But like I said, right, for university, they probably have a very good idea in terms of in the next 5 years, right? Maybe we're going to have the same government, provincial government,
yeah,
right? And we know their commitment, so therefore we know our revenue, right? So,
right. Thank you so much.
Yeah, that's a very good question. So let's see this master project. Okay, master project. So you all start from the sales project, okay? You start from the sales project. So this project is driven by number of units sales, number of units sold, okay? So when you prepare your sales project, the most important thing is you have to estimate how many units you are going to sell during that budget period, okay? So that's the key information driving this project. And then that will flow into the production budget, okay? You have to be careful that units produced is not equal to units sold, right? So how much you can sell is not necessarily always the same as how much you can produce, right? And the difference will fluctuate that inventory level, right? Okay, so in the product budget, you are going to need the information, the number of units sold from the sales project. At the same time, you have to also take into consideration the beginning and ending inventories, right? Because the difference between the units of production and units sold is reflected in the inventory, right? If you produce more than you sell, your inventory level will go up, okay? If you sell more than you produce, your inventory level is gonna go down. Does that make sense? Okay, I'm gonna say this again. If you sell more than you produced, your inventory level is going down, okay? So that will be the situation that when COVID is here, everyone is going to buy the toilet paper, and then you see the empty shelves, right, of the toilet paper, right? So that's the situation is you sell more than you produce, right? So your inventory level go down, right? And So when you produce more than you sell, right, your inventory level is go up, okay? So in the production budget, it has no dollar amount. It's all about units, okay? It's about what is the beginning inventory, right? What is ending inventory? What is the amount of production? And what is the number of units sold, okay? So production budget is just about units, the number of units. It's not about the dollar amount, okay? And so when you talk about production, right, then you cannot avoid product cost, right? So then the product cost has the three components: direct material, direct labor, manufacturing overhead, right? So you're gonna do a budget for each of them, okay? And the selling and the admin expenses budget, this is not a product cost. This is it's not a selling and administrative expenses budget is not a product cost. It is a
period cost.
Yeah, period cost, right? So you're gonna also have a budget for this expenses, right? So with this, you know sales, you know cost, you know all these expenses, you have a budgeted income statement, okay? And then that budgeted income statement gives you budgeted operating income. That goes to the cash budget, right? Remember, when you prepare a statement of cash flows, right? There are three activities: operating, investing, and financing activities. Under the operating activities, right? Remember, if you use the indirect method to prepare a statement of cash flow, you start with what under the operating activity? Indirect method, you start with a number. What is that number?
Is it revenues?
Close. It's not revenues. It's a number from the income statement. What is that? So you remember there are three activities, or maybe you don't. Megan?
Well, I was gonna say sales, but now I'm worried that that's not right.
Okay.
Never mind.
Yeah, okay, so this is a recap for 2100. So to prepare the statement of cash flows, you have three activities, right? The three sections: operating, investing, financing, right? For under operating activity, using the indirect method, you start with net income, right? You start with net income, you add back, depreciations, right? You do remember? Must be well, okay? So you can see that in the budgeted income statement, right? So the net income is gonna come to the cash budget right here. And also you talk about investing activities and the financing activities. Those are the capital expenditures, right? So that's going also to cash budget. And with this, you have the cash balance, right? So you can have a budgeted balance sheet, okay? Budgeted balance sheet. So now we are saying that, from the sales budget until the budgeted income statement, we call this operating budgets, okay? We call this operating budgets. This gives us a budgeted income statement. And this cash budget and budgeted budgeted balance sheet, we call it financial budgets, okay? Financial budgets. Okay, question 1. Which of the following is not a reason why firm use budget? Florence?
D, operating leverage.
Okay. Okay, next, let's see. Just give me 1 second. Xudong?
D, the operating.
Okay, Ruben?
D, operating leverage.
Ashley?
D as well.
Michaela?
Also D, operating
Okay,
leverage.
so it's all D, right? So it's D, yeah, operating leverage. This is not why firm use the budget. Okay. Okay, so now let's take a look at the sales budget. Right, sales budget is relatively very straightforward. So what's your sales revenue? Your sales revenue equals the unit of sales times selling price per unit. Okay, I'm thinking I can sell 10 units. Each unit is $100. So my sales revenue will be 1,000, right? So the sales revenue, that's going to the income statement and the cash budget. This sales revenue, that information will flow to the budgeted income statement and the cash budget. And the unit of sales, that goes to production budget, okay? That goes to production budget, which I have talked about, right? I've talked about. So let's take a look at this. Suppose this is ABC company. They are expecting the sales for the 4 quarters of the year is 3,000, 3,500, 4,000, and 4,500. Okay, that's the expected units of sales. The selling price per unit is $60. Okay, so the total sales, you just use expected unit sales times unit selling price, right? So that's how you get 900,000 for the year. Is this clear?
Yeah.
It's pretty straightforward, right? For sales budget. Okay, now let's take a look at the production budget. Remember, production budget has no dollar amount, right? It's only the number of units, okay? Okay, so I know, okay, I am expecting to sell 3,000, 35, 4,000, 45, right? I know this. This is from the sales budget, right? This is from the sales budget. How many units of sales I can make. And also, I just want to have a little bit of safety margin, right? I want to have ending inventory, right? I want to have the ending inventory is the 20% of the next quarter's sale. So the first quarter's targeted ending inventory is 20% of second quarter's sales. So the second quarter sales is 3,500, and I want to have 20% of that as my first quarter's ending inventory. So 20% times 3,500, that's my 700. So at the end of the quarter 1, I'm hoping I have an ending inventory of 700, and I will sell 3,000. So I have to have 3,700, right? So I have to have 3,700 units because I will sell 3,000, right? And I need to have 700 left in my ending inventory to prepare for the next quarter, right? So in total, I have to have the 2 numbers. I need to have the 3,000, which I'm going to sell. I'm also going to have the 700 left. This is just to prepare for the next quarter, right? So together, I need to have 3,700 units. And in the beginning, I have 600. Okay, in the beginning, I have 600. How much I need to produce? Well, I need 3,700. And in the beginning, I only have 600. So in the first quarter, I have to produce 3,100 units. Okay. So let's take a look at the second quarter. So you have 3,500. This is the amount you are going to sell, right? So the ending inventory is 20% of the sales of the following quarter. So that's 20% of 4,000. So your ending inventory is 800. Plus you are expecting to sell 3,500. So in total, you have to have 4,300, right? And what's your opening balance? You know, this 700 is come from the ending inventory, right? Because the quarter 1's ending inventory balance is the beginning balance of quarter 2, right? Okay, so the ending balance for Q1 is the beginning balance of Q2, right? And we know that number is 700. Okay, so for Q2, I needed to have in total 4,300, and the opening balance is 700. So I had to produce the difference, 3,600 in Q2. Okay, does this make sense?
Yes, thank you.
Mhm. Thank you. So then you just keep going, right? Same idea, just repeat the same logic, right? You do Q3 and Q4, right? So this is your production project. You didn't see a dollar sign, right? You didn't see a dollar sign. You just want to know how many units I need to produce, right? Did you see? It all starts from the number of units sold, right? From the sales project. And then you come to the bottom, that's the required production units, okay? And in the middle, that's the beginning inventory and the ending inventory, okay? Does anyone have questions about production projects? No question? Okay, let me see. If you understand this, please give me a thumb up. Okay, awesome. Okay, you guys are paying attention. Yeah, thank you. You are not doing Facebook. Thank you very much. Okay, Tammy, you raise your hand.
No, maybe it was for the last question.
Okay, yeah, that's okay. Yeah.
Mhm.
Okay, so here is the question. So remember, if you have already get 10 or more than 10, let's leave the participation opportunity for those who need more marks, okay? So if nobody else is answering, then please, right, raise your hand. So let's do this question. I'm going to give you 2 minutes to work on this question, okay? Do you have an answer yet? Erin,
I found D.
D, okay. Let's wait, see what other people get. Thank you, Erin. Hallie?
I also got D.
Okay, thank you, Hallie. Patricia?
Oh, sorry. D.
D?
D.
Okay.
Yeah.
D, okay. Rachel?
I also got D.
Kate?
D as well.
Hussein?
Yeah, same. I think it's D.
Okay, so Hussein, how did you get a D? How did you get the number 9375?
Actually, tried to do it the same way that you did it, like with changing the numbers.
Do you want to walk me through it? Okay, Erin, can you please walk us through this question?
So the way I found D for this question is because sorry, I have flu right now. That's why my voice is kind of like this right now. But yeah. So for the expected unit sales for April was 9,000, right?
Mm-hmm.
And I times that by 75% to get the beginning finished good units, which was 6,750. And then to find the ending finished good units for April, I had to multiply 9,500 for May times 75%.
Yeah.
And yeah. And then just added them together, then subtracted it.
Yeah, very good. Thank you. Yeah, the way how I do it is I use May and April, the difference in terms of unit of sales. So that would be 500, right? 9,500 minus 9,000. So 500 times 75%. So that's 375. Okay, that's the 375. So, and then I add that number to the 9,000. So that's how I got this number. Okay. So exactly like Irene said, right? You find out what's the ending inventory in April, what's the March ending inventory. So you are using the ending inventory plus the number of sales minus beginning. So that's how you get this number. Okay. But the quick way is just to 9,500 minus 9,000 times 75%. Okay. And then plus 9,000. Okay, let's see this question. So we are okay with the production budget, okay? So now let's work on the direct material budget, okay? Direct material budget. So you are going to report 3 key pieces of information. First, what's the units of direct materials, the number of units, right? Direct materials you needed to meet the production inventory need, okay? And then how much direct materials you have to purchase, okay? And what's the cost, okay? What's the cost? So the cost you purchased the direct materials, that's the cash you paid. That goes to the cash flow budget. So here's one example. How are you gonna calculate direct materials needed for production? Well, how many units is going to be produced? That's from the production budget. How many units is going to be produced? That's from the production budget. Times how many direct materials you're going to need per unit, right? To produce each unit of the good, how many direct materials you're going to need, right? So we are saying this is the direct materials units. Okay, how much you're gonna purchase, okay? So this is direct materials units required for production, okay? You add the ending inventory for the direct materials. That's the total materials you should have. And then you minus the beginning inventory balance. That's how much you are going to purchase, okay? That's how much you're going to purchase. So how much you need is different from how much you purchase. Okay. So let's say in my refrigerator, I have 2 eggs, right? I have 2 eggs left, right? And let's say tomorrow I'm going to eat 6 eggs. I don't eat that much eggs, right? I'm just giving you an example. So how much eggs do I need for tomorrow? How many eggs do I need tomorrow? Rachel?
Sorry, that was my hand from
Okay.
the last question.
Yeah. Maddie?
Would it be 4 because you have 2 right now and then you need 4 to get to 6?
Okay, sorry, it's me. I'm not asking the good question, right?
Oh,
So
okay.
by tomorrow, because I'm going to eat 6 eggs, right? Like tomorrow. So so in order for me to be not hungry, how many eggs do I need? Rachel?
6.
Yeah, and in the refrigerator there are 2, right? How many should I purchase?
4.
4, right? You see, how many do you need is different from how many you are going to purchase, right? Because you have an inventory, right? You have an inventory there. So that's why you have these 2 formula, right? You have these 2 formula, okay? And then this last one is easy. What's the cost, right? So basically, how many you are going to purchase, the units you are going to purchase times the cost per unit, right? So that's the cost. Okay, so you can see it comes down from these units to be produced. That's from the production budget, right? So that drives all this along, right? So I figured out how many I'm going to need, the materials, and then I'm going to use my inventory information for the direct materials to figure out how many do I need to purchase, right? And if I know the units purchasing price, I'm going to know the direct material cost, right? Okay. Okay, so do I still have time? What time is it? Okay, I still have 10 minutes. Okay. So let's see this example, the same ABC company. We have done the sales budget and we have done the production budget. So now let's work on the direct materials budget, okay? Suppose that the materials inventory, the ending inventory has to be 10% of next quarter's production requirement. Each finished product unit requires 2 kilograms of raw materials at an expected price of $4 per kilogram. So from the production budget, we know that we are going to produce this amount of units for the 4 quarters. These numbers are from our production budget. I'm going to show you here. Did you see? This is our production budget, 31, 36, 41, 46, right? So we are going to use that information, right? 31, 36, 41, 46. We're going to use this information to do the direct material budget. So that's my production, right? We start with the production units, and each unit, finished goods, is going to use 2 kilograms, right? So I'm going to times 2. So now this is my kilograms needed, right? And remember, for the materials ending inventory, I want it to be 10% of next quarter's production need, right? So next quarter, you're gonna need 7,200 kilograms. So 10% of that is 720, right? So for quarter 1, I'm gonna need for production 6,200, plus I want to have an ending inventory of 720. So in total, that's my 6,920, right? And then in the beginning, I have 620, okay? So I had to purchase 6,300, right? That's how much materials I need to purchase, kilograms. And each kilogram costs me $4. So this number times 4, that's my 25,200 for quarter 1, right? So same idea, you can calculate what's your quarter 2, quarter 3, quarter 4, okay? So does this make sense? Does this make sense?
Yes, it does.
Okay, good. Yeah. So don't be scared by the budget project, right? Don't be scared by it. You just have to be able to analyze the information from the case, and you are doing something similar like this, okay? Okay, let's work on this question. This time, if you get an answer, you send your answer to me through the chat, and don't send to everyone. You just, I believe you can send a direct message to me, right? You can just send it to me. If you know the answer, send the answer to me, okay? I feel, you know, psychologically, there is a principle called conformity. That means if you observe many other people are talking about one thing, and then you believe that that's most likely to be correct. So therefore you just conform, right? Even though you get a different answer, you still think, well, I better conform with the group, right? So that's called there's this conformity theory in the psychology. So I don't want other students to know your answer, right? So if you are done with your answer, just send me the answers through the chat directly to me. Don't go to everyone, okay? If you didn't see the answer, just write down your answer to me. If you get an answer that is not on the list, just send that answer to me. Yeah, I started receiving some message, okay? There are 4 students have already responded to me with the answer. The true answer may not be in this question, may not be on the list, A, B, C, D. So, you know, Okay, because the time's sake, I still have 3 minutes. So let's see. Okay, so Dan Pearson, can you please explain your answer? How did you get to the calculation?
I think I did it wrong because I was looking for March, but basically I took the production for March, which was 875.50.
Mm-hmm.
And then multiplied that by 3 for the number of units I need to produce.
Yeah.
Right. And then I wrote that number down. And then I took April amount by 20% times 3, because that's the extra I need to make. Is that right? And then subtracted February's 20% to make it quick. But I think I did it wrong because just I'm looking at the answer. I think I'm supposed to use February, March, and April, right? Not March and April.
So this is about how many should a ABC purchase in the month of March, right?
Yes. Yeah. And I think when I calculated, I used March and April. I didn't use February's beginning inventory.
Okay.
That's where I think I made a mistake.
Okay, so let's see. So let's see if this is correct. So March sales. Okay, so that's March sales. It's March production, right? So I think
Yeah.
Yeah, so March production. So because this is direct material, so March production. So that's 8,750, right? So materials required. So that's gonna be 8,750 times 3. So that's 26,250. Is that correct? And then April, so that will be 20% of the next month's production need, right? So April, so that's the ending balance, 20% of this, right? This is a production, the next month's production needs. So this number times 20%, that's the ending inventory of the materials. And this number times 20%, that will be the beginning inventory number, right? So then when you do this calculation, 26,250 plus 20% times this difference, you get answer C. Okay. Okay, so we are 45. Okay, so next class, we are going to finish this project, okay? So make sure you start looking into that project, okay? And make sure you definitely need to get together with your group members, okay? So let me see. Class is dismissed. If you have any question, please stay, okay? Class is dismissed.